Thank you for standing by, and welcome to the Credit Corp Group Limited FY21 Full Year Results Conference Call. All participants are in a listen-only mode. Credit Corp CEO Thomas Beregi will do a short introduction, and then we will open for questions. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Thomas Beregi, CEO. Please go ahead.
Thank you, everyone, to our 2021 results Q&A call. As has been the case for a number of years now, we don't propose to walk through the presentation or make any introductory remarks of substance. The presentation was posted a bit earlier today, and we have a recorded version on our website, and you'll see a link on the media release that should take you directly there, and you can view a recording of the presentation. Hopefully, most, if not all of you, have had the opportunity to view that, and so this call will purely be about questions, an opportunity for you to ask questions, and for myself, Thomas Beregi, and our CFO, Michael Eadie, to address those questions in this forum. So what I'll do now is hand back to the operator, and we'll take your questions. So thank you.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Scott Murdoch of Morgans. Please go ahead.
Morning, Thomas and Michael. Firstly, just an obvious one on the guidance range, if I can. Clearly, a couple of scenarios that can play out through the year, but just interested if you can provide us some colour on the assumptions around the bottom end of the guidance range at 85 million NPAT.
Yeah, look, that's a confluence of a few different adverse events or events that we thought might be possible. Potentially, if the loan book were to grow very rapidly, and we'd have the upfront provisioning impact may affect us there as well. It allows for the potential that our purchasing doesn't grow from the current committed level that we've disclosed of about 150 million, and it also allows for some deterioration in the collection environment. Right at the moment, none of those things are looking highly likely, but it's been a fairly unstable period over the last year to 15 months. So that needs to be reflected in the guidance we provide.
Okay, thanks, Thomas. Makes sense. Just secondly, I've got a few, if that's all right. Just secondly, on the US outlook and the pipeline strength that you've achieved there, can you just give us an idea of what the recent experience has been in the US in terms of sort of tender outcomes and achieving that better pipeline position heading into this year?
Yeah, well, certainly volumes appear to have recovered a bit in the US, but most critically, we have a lot more headroom there to grow, even in a constrained or contracted market, which is still the case, where charge-off volumes are lower than they were pre-COVID, but our sort of ingoing market share was just around 3%. So we have the potential to grow our purchasing even in a more limited market, which we've done. We have seen sort of prices come back to pre-COVID levels, and in some instances we've seen them go above. I guess our estimate is that in terms of the market and the bidding behaviour of competitors within the market. I mean, some reasonably strong collection outcomes are being achieved on purchases we're making presently in the US. I think we are probably benefiting, and we do highlight this in the materials, benefiting from some of the stimulus that is being layered on top of a sort of reasonably buoyant sort of consumer economy.
Okay, thank you. And just sticking with the US, simple question, just interested in your expectation on collection staff, the requirement to increase them through the year, and your actual ability to hire collection staff with the labour conditions?
Yeah, right at the moment, the key factor that has been impacting us to date has been the attractiveness of not working. So while it might be sort of helping our collection results, the fact that there is so much support out there in the US, particularly up until really just early last month in Utah, the combination of both federal unemployment support and state support has meant that you can earn a competitive amount by not working, competitive with the sort of employment that we're offering. So that has made it difficult for us. Utah, I think, ceased unemployment support early last month, so we're now seeing better numbers come through in response to our recruitment activities, and we've got a way to go in Washington State. I think it's not until September that the federal support there is withdrawn, and that we would see ourselves as sort of more competitive with some of these alternative options. So it has been difficult to recruit in that environment, but we've got a pretty good proposition for people, and those who have joined us are very positive about the experience and are referring their friends. So we're confident that we can grow our headcount as normalcy returns to the employment market over the next few months.
Okay, thanks, Thomas. I've just got one more and then I'll jump back in the queue. But just on the lending division, notice that the provisions against the book have actually increased from this time last year. Just interested, and they're clearly well above the pre-COVID levels. Just interested on a bit more colour around the quantum of the provision that's now being held.
Yeah. Well, as I guess as you can derive from the accounts, we're carrying now around 26.5% against the book. Now that reflects the sort of very much the abnormally low levels of arrears and losses that we've seen sort of throughout most of this COVID period, and because we've continued to provide at the pre-COVID level, which is in line with the underwriting, which is also now being done on the basis of pre-COVID settings. We've that provision has actually built up, but we anticipate that as there's a return to kind of more normal economic conditions and consumer behaviour, that we will need to utilise that provision, and we'll see losses sort of go back to those pro forma levels.
Okay, thanks, Michael. I've got more, but I'll get back in the queue. Thank you very much.
Thank you. Your next question comes from Tim Lawson of Macquarie. Please go ahead.
Hi, gentlemen. Thanks for taking my questions. Just in terms of the commentary on the US, you talk about a sort of increased investment there, but over a sort of medium term to fill that capacity. Can you just remind us what that medium term sort of means?
In terms of investment
Sort of
amount?
how long? No, you
Sorry?
talked about how you increased the investment and the number of seats in the Washington business, but you talk about sort of targeting $200 million investment on the PDLs over the medium term. So just trying to understand exactly what that means.
Oh yeah, sure. So there's a prospect that we hit a figure like 200 million inside the next 12 months. But we're talking sort of 12 months to 12 to 24 months to be hitting that, and hopefully sustaining investment levels at or above that. that will require a little bit of catch up in headcount. So with the difficult recruitment environment, it has, our headcount has run off a bit in the US, and so we need to build that back up and start filling our capacity in that Washington State site. But yeah, we're the 200 million is a figure that is, while not presently within our guidance range, there's some prospect that we could get close to that even this year.
Yeah, okay. And you mentioned on the video you had put out in that link that you've got 3 new US issuers. Can you just talk a little bit about those groups?
Yeah. So 2 of them are sort of smaller, sort of regional credit issuers, and one is a probably a larger fintech issuer. So issuer of personal instalment loans, I guess. And the commitment we have there is a reasonably sized commitment.
Okay. Maybe just jumping around a little bit on the consumer lending side, previous question in terms of holding the pre-COVID provisions, what are losses running at in terms of that book? Actual losses rather than the provisions?
Yeah, look, they're running sort of at around 4 to 5% below pro forma at the moment.
Okay. And then just in terms of the collection house book, maybe it's too early to say, but can you comment on the sort of performance of that, the potential bonus payments over time should you do exceptionally well?
Yeah, look, the book has performed well. It's pretty much in line with expectations. So the actual cash collections banked to date on that book are pretty much in line. Very small outperformance at this stage. It's still a very large book, and our focus to date has been on the older components of the book, which are closer to their statutory barriers, to make sure that we realise that value before we can no longer do so. And progressively, we're hopeful that we'll see a trend of outperformance emerge over the next 6 to 12 months. Having said that, it's still extremely unlikely that it will outperform to the extent where it triggers the pass back of any receipts to the vendor of that book.
Okay, thank you. And last question from me, just on the 293 purchases in the year, I mean, slightly below what you thought you'd get to. Can you just talk about how much that's just the underlying volumes versus any sort of timing impact of things that have fallen into the next year, and has that sort of impacted that one sort of 50-odd contracted as you launch off into FY22?
No, it's all existing forward flows underperforming in volume. So we base our guidance on discussions that we have with our clients around their projected charge-off volumes, and consistently there has been sort of underperformance in terms of volume. So just an underestimation of the impact of forbearance and moratorium programs by contracted forward flow issuers, and also a bit of slippage on some inventory files that typically would be tendered before the end of the year. That's generally not baked into our guidance, but in normal conditions, provides a bit of a buffer, or provides an outcome where we can potentially sort of outperform our guidance if we get volume there. But a number of those either didn't occur or were pushed into the present financial year.
Okay, that's it for me. Thank you.
Thank you. Your next question comes from Russell Gill of JP Morgan. Please go ahead.
Hi guys, just to follow up to that PDL question, your 150 number is a very, very round number. as at July relative to previous years. Is it possible to break down that 150 between Australia, US, and what's, I guess, your estimation of forward flows relative to inventory sales?
Yeah, look, the contracted is all forward flow, so that's the first thing to say. And I think we've provided in the materials it's 110 million Aussie for the US and 40 million for Australia.
The 40 number, I guess, is quite a low number relative to, I guess, the history of the market, and obviously there's an indication of a recovery of PDL volumes coming through. Is there a timing around the forward flow agreement so the next couple of months that could change that dynamic on that 40 relative to where you might be in previous years?
Yeah, look, I don't think that's necessarily the biggest factor. However, I think in terms of the timing, I don't think it's necessarily so abnormal at this point. There are a couple of discussions that are ongoing that we would hope to conclude very shortly. But yeah, the timing is not particularly adverse relative to prior years. It's more so volumes. So having I guess fallen a bit short last year, we've based our volume projections not so much on what our clients are telling us, but more so on the realised run rate. So there's a prospect that the amount we've allowed for each forward flow will outperform. It will have higher purchasing volumes as volumes grow.
And if we think through your last couple of years in Australia have been assisted by some transactions, Bay Corp and then Collection House. There are some transactions around, like the Citigroup exit, etc. When you give your guidance to that 200 to 240, is that purely on the assumption of forward flows, or do you have potential inventory sales into that expectation?
Yeah, look, there are potential inventory sales, but generally no expectation that we would make a large secondary purchase from one of our competitors. So we wouldn't necessarily have an expectation of a Bay Corp or Collection House purchase again. But yeah, we certainly do allow for the prospects of inventory sales direct from credit issuers.
Thanks, Thomas. And Michael, I apologise for harping onto this, but I obviously just don't get it. Your consumer loss provision, which has gone up to 27%, that's 27% across the whole book. If you look at the last 6 years, it's been running 19, 20%. Then you bumped it to 24 in June, and now it's gone up to 27. Obviously, you've pushed lending in that last quarter. Is there a loosening in your underwriting standards? Is there just some conservatism based into that? Like, can you possibly just detail why the overall book provision has gone up where it has?
Yeah, look, I might start, and then Michael can chime in with a bit more. But we've, in terms of where our underwriting standards are, at the beginning of the final quarter, you will know from history that our underwriting standards were tighter than sort of pre-COVID all through last year, and then at the beginning of the final quarter, based on the arrears and loss experience that we had seen, we removed all the additional overlays, and for that quarter we lent on basically sort of pre-COVID criteria, and that's still the case today. We are seeing, very low loss performance. We haven't adjusted our underwriting criteria for the level of losses and arrears that we're seeing. That would, if we were to do that, we would further, loosen our credit criteria, which we haven't done. So, look, it's just accounting for the fact that there will be a reversal at some point. We don't expect these conditions to continue. It's not the basis on which we're lending, and it's an accumulation, I guess, to some extent, sitting in the current book of events that we expect to be impacting our consumers that will lead to, higher losses and somehow, sort of almost a recoupment of the very low losses we've been experiencing over the last period.
So the upshot is, in the fourth quarter, you went back to pre-COVID levels. You've got a rush of volume coming in, and you've got a level of conservatism just based on the outlook that you've decided to put the provision a bit higher than either loan loss experience or the history of your book, just on, I guess, concerns on the outlook rather than anything else. Is that the best way to address it?
I mean, Michael can probably go into the detail, but it's probably more a case of us providing to pro forma and the losses simply not coming in. So it's not as though we've made some specific decision to, say that, more of these loans are going to write off. It's just they aren't writing off, and we're providing at that 18 or so % that we have historically, but the provision is not getting exhausted by losses. But I might ask Michael to add to that.
Yeah, it's probably also worth noting that the level of the provision is the same as it was at the half year, at December. So, it's the same approach that we've taken throughout. We've been providing at the kind of pre-COVID pro forma levels. And, whilst the loss experience is lower, that's meant that the provision we're carrying at the moment is higher. However, we do expect that will reverse. And, we'll need to use up that provision to absorb higher losses as normal conditions sort of start to return.
Cool, yeah, we unfortunately don't get to see that detail at the half, but I understand where you're coming from. In your expectation to grow that book back to where it was, the run rate of gross, Thomas, do you think you can keep doing that at, I guess, the pre-COVID level criteria, albeit with the July issues around lockdown? But, what's your timing expectation in getting that book back to pre-COVID gross lending?
Yeah, look, it's probably still around 18 months from today to get it back to that figure. So still a way ahead. Obviously, what we've experienced in July might push that out a little bit. And, it may continue for the next few months in that lending volumes have softened a bit. But we're hopeful that when things return to normal and people are able to sort of spend again, that we'll recover.
On the basis that the actual loss experience over the last 18 months hasn't been what everyone had expected, I guess, in the consumer lending book. What's happened from the competitive dynamics? Have you seen a change from competitors in the space around marketing and trying to drive volume growth or pricing from the competitive dynamics? What are you seeing from the competition in the space?
Yeah, look, it's hard to say. I mean, we haven't seen a huge amount of marketing. I mean, we've been able to spend less and acquire the same number of customers as we might have pre-COVID and approve them. That was our experience in the final quarter. So we're not seeing, heavy competition in the sort of digital marketing space. However, there are some competitors out there who are reporting, very, very significant loan book growth. But it's hard to see what is driving that. I mean, look, it's only a guess, so take it for what you will. But it does seem as though potentially we have said we've loosened our settings, but only back to pre-COVID levels. But if you're a more recent entrant to the market and you're looking at your loss rates and you don't have a long history, you may loosen your credit criteria even further, and end up lending to people that maybe ordinarily you ought not to, or lending amounts that might be excessive for those individuals, just in terms of the overall economics of your book. So that's all, but it's just purely a bit of speculation, because we're not really seeing, we're seeing some extraordinary numbers by different players, but we're not really seeing that in terms of, pressure on our marketing and our new customer acquisition.
Great. And I'll see if I can draw you into answering this question. We'll see. But you mentioned that you've got some clients now in the personal instalment loans, fintech personal instalment loans in the US. Obviously, there's been a shift over time away from traditional credit cards and personal loans into some of these offerings. What are your thoughts on pricing that marketplace? And I don't know how much experience you have in terms of, your collections on it, but what's the return profile and pro formas across that client base relative to the traditional segment looking like in the US?
Yeah, look, we've been buying those sorts of loans for probably 5 to 6 years now, and we've done quite well on them. Often the balances are a bit larger than the traditional credit card buying in the US, so that just affects the timing of your returns. There's less cost as a percentage of collections because you're dealing with larger balances, and so you do get a bit of that sort of margin leverage there. But competitive with the returns, we're pricing to the same return criteria. Generally, a number of these players are probably lending to sort of what you call sort of more mid-prime rather than prime customers. But that's baked into the price we pay, and we feel we have a long history of collections now on those purchases, and we can bid quite confidently in that sector.
Great. Thanks, guys.
Thanks.
Thank you. Your next question comes from Simon Fitzgerald of E&P. Please go ahead.
Thank you for taking my questions. Just wanted to know, out of some of the recent forward flow agreements that have rolled, has there been any reluctance of sellers to, say, put those forward flows out to 12 months and instead perhaps, shorter durations?
Look, there has been some one or two where there's been shorter durations, and I think that's more in response to the price decreases that were agreed last year, and so sellers or credit issuers presumably have an expectation of recovering prices, and therefore don't want to lock in for a long period at a price where they think they might be able to do better in the future.
Mm-hmm. Okay, and then just the final question. Obviously, you're starting to get a pretty long track record now of the domestic consumer lending business. Are there any thoughts to start a similar business in the US?
Yeah, look, it's always something that's on the agenda, and we're always looking at that market, and it is interesting. There would be some particular challenges, but it is it is part of the plan going forward. Would be to spread lending operations into other markets.
But at this stage, you don't have a US lending business that you're looking at starting or anything this FY22 year?
Look, we'll certainly take some steps as to how far we get. When something happens, it'll be out there, and we'll tell everyone about it.
Excellent. Thank you for letting me know. Great.
Thank you. Your next question comes from Sinclair Curry of Novaport Capital. Please go ahead.
Okay, thanks for taking the questions. Just interested in the loan book. I think look at your previous high in net lending was around $65 million. And it's interesting for the coming year, you're talking about 55. Would a 55 net lending run rate be consistent with getting over that 18-month period that you outlined before on the previous question to about that sort of $230 million loan book? Would that be a fair sort of assumption, or am I getting the numbers wrong?
Yeah, no, that's correct. Yeah, it would take sort of in that, those 12 to 24 month type time period. to get back there. Yeah, probably. Yeah, would depend on the type of products we're writing, the auto loans, etc. But yeah, in broad terms, it would be sufficient.
Okay. And in terms of the NPAT or the profitability implications of getting that net lending of 55 for the year ahead, given historically, you had the $65 million, I think you were coming off a higher base of a book. I'm just sort of thinking that's going to be a bit of a constraint on earnings from that book. It'll reflect a higher run rate of lending growth to what you've had even in the second half, from what I can see. Is that a fair statement, or am I off the money there?
No, it should be. It's broadly in line with what we've done in the second half in terms of run rate. Yeah.
Okay, rightio. And there's going to be an added complication if you grow the auto book. That's typically longer duration, presumably.
Yeah, correct. So, obviously we benefit in that it means the book can kind of build up more quickly, doesn't amortise as rapidly, larger amounts, longer duration. Yeah.
Cool. Thanks, Michael. Thanks, that does me. Thank you very much.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. Your next question comes from Shane Bannon of Bly Capital. Please go ahead. Shane, please go ahead.
Oh, sorry. I had just one question with respect to the shape of the market in the PDL space domestically. I mean, with the acquisition of Collection House and also Baycorp, obviously the structure of the market's changed. I just wonder or could you just give a little bit more flavour as to how the market is either expanding or contracting, and the attitude of vendors in terms of letting books go to what looks to the traded marketplace.
Yeah, so look, sellers seem, as far as I can tell, as committed to debt sale as they ever have been. It's an important part of their sort of arrears and sort of credit management process, and many of them have, come to rely on it fairly heavily. And so, yeah, while there was a period of temporary withdrawal, all those who were selling immediately prior to sort of March last year are back selling today. So there's not really any issue there. In particular, the main issue is just the volumes that are being sold are quite tight, so quite low relative to history, and we've touched on that already, so I won't cover that ground. In terms of the buyers, yeah, look, I guess in the 12 or 24 months leading up to our acquisition of Baycorp, they weren't buying very heavily in the market, and similarly for Collection House. So it wouldn't really be the case that our acquisitions sort of changed the balance as against what was happening immediately prior to the acquisitions. But yeah, look, so we've seen other players come up and grow in the market. So yeah, it's still relatively competitive, and with the volumes at the moment, it's being so low. It's not as though right at the moment the market is sort of challenging the financial capacity of a lot of our smaller competitors. So they're able to bid quite quite competitively.
Could I ask you, and to extend yourself a little bit further, Thomas, how do you see that evolving? Are we going to see more capital come into the market to try and occupy the space, as obviously more books come to the market?
Yeah, look, possibly. I think it will be interesting to see. That's certainly a possibility. I think one of the issues I think for investors and the providers of that capital, has been, the issues faced by some of our competitors. And so certainly I think, debt capital credit to the sector is very tight and very, very expensive. We've seen that, one of our competitors is, paying a coupon or interest rate of something like 14%, and I think another is paying 19%. So, there's some bank funding is very, very constrained now. There were years when, the banks, or the number of the banks were very much, were greeting the sector with open arms. Now I think we're pretty much just down to one, which is our funder, Westpac, our bank funder who participates in our syndicate, takes the majority of our syndicate, and certainly, their attitude to the sector is not the same as it was a few years ago either.
Great, thanks, Thomas.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. Your next question comes from Stuart Turner of Blue Ocean Equities. Please go ahead.
Oh, thank you. Hello, gentlemen. I guess just following on from Shane's question, I was just wondering what's going on within the banks. I mean, we say that they're kind of back selling today. Well, what's holding them up? What are the unit economics for them to be selling more? I thought it was always quite compelling because they are relinquishing the need to hold capital against a certain part of their book that isn't performing to expectations. Is that not the case, or are they just withholding because of social concerns?
Yeah, look, I don't think there is any particular policy or any sort of change to the economic proposition presented by debt sale. It's simply, the volume of charge-offs. If you look at their announcements, just the arrears and losses that they have been incurring on their unsecured books have been incredibly low. We had 2 rounds of superannuation withdrawals, so anyone who was at all sort of falling behind or was having trouble with their credit position or their financial position was able to cure it, particularly from an unsecured perspective, given that, the average charge-off balance, for a credit card is in the region of about $7,000. So it's an amount that those superannuation withdrawal amounts can readily cure. You layer then on top of all of that prepayment, and we saw quite large runoffs in the credit card books over that period. So a lot of prepayment, and then layer on top of that forbearance programs, which are now starting up again, where a consumer rings up without a lot of sort of scrutiny. Someone's in arrears. Ordinarily, that person, they would just march out from 30, 60, 90 all the way through to 180 days and get charged off. Anywhere through that process, the collections officer at the bank can say, are you experiencing any difficulties arising from COVID? And immediately that might trigger an up to 6-month deferral. So instead of that person who's in arrears, who might be, say, 30 or 60 days in arrears, they won't come out of arrears in 120 days. It'll now, if they get a 6-month moratorium, now you're talking 300 days. So, that just defers all the charge-off. That's what I believe is happening, and that accords with the views of our clients and the forecasts they've provided us for charge-off volumes.
Great. Thanks a lot, Thomas.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. Your next question comes from Mark Hancock of Precept Investment Actuaries. Please go ahead.
Thomas and Michael, hi. Just wanted to ask, in terms of the contribution from Australian and New Zealand ledgers, the full year result was 54 million, which was just slightly softer in the second half, yet you had a very strong contribution from the acquisition of Collection House at the end of last year. So it seemed like a pretty sharp drop off in the rest of the book. And I just wondered, was there any unusual factors going on there in the collections or any other issues that we're not aware of?
Oh, look, I think, Mark, the main issue was obviously in the first half we benefited from some of that sort of very high levels of stimulus, including that second superannuation withdrawal and sort of half of the original JobKeeper and other forms of forbearance as well. So I think that sort of, I guess, boosted the first half and in the environment where we were investing less also. So that's kind of the main explanation. That Collection House to some extent, I guess, sort of overcame the impact we would have otherwise experienced from relatively low investment.
Sure. Okay, that's very good. And I noticed when you look at in the appendix, the payment arrangements at a record 1.6 billion, yet they're contributing 83% of PDL collections, which is up from 73% a year ago. So does it reflect that other collections are weaker rather than outside the payment arrangements?
Yeah, more of a function of just the lower purchasing, and also the fact that the Collection House book being a secondary purchase sort of came with a banker payment arrangements.
Oh, yeah. Right, yeah, of course, yeah. And just with regards to COVID and the Sydney lockdown, the economy's sort of in a more difficult position than it was possibly even last year during earlier lockdowns, which were fairly short-lived. And yet this year, there's less stimulus, federal stimulus, etc., and the superannuation aspect's gone. So I just wondered, how are you seeing it playing out for your business in both ledgers and consumer in Australia in that sort of different environment? And are you, for example, tightening up lending criteria in the consumer book?
In terms of the ledger purchasing business, at the moment we're not seeing anything adverse. So if we go back to sort of March last year, late March, early April, there was a fair degree of consumer sort of panic. We're certainly not seeing that at all. So there's been no degradation in collection outcomes. So, and in some ways, I guess that's to be expected. Consumer incomes don't appear to have been substantially affected. And while there's nothing the equivalent of JobKeeper at the moment, there are various programs. They're probably a little bit more difficult to access this time around, but they're still providing support, and at the same time, people just don't have the spending options as well while they're in lockdown. So we're not seeing any degradation in collection outcomes at the moment, and we're not necessarily expecting that there will be over the next few months, even if things continue. The different story in the lending business. So as we've indicated, July was softer than we would have liked, and softer than the figures that are predicated in our guidance, or at least the top end there in terms of lending volume. So, but hopeful that will recover as lending volumes did last year when lockdown and isolation measures came to an end. So we put it down to potentially a bit of caution, as well as more limited spending options means there's simply not the demand for credit that there is when people are able to get out and about and shop and do other things.
Thanks, Thomas. Just if I've got time, a question on America. Assuming that you continue to grow the book pretty strongly there, do you anticipate America would be your largest source of profit growth in FY22, or is it the case that the large investment in people and ledgers would actually mean that sort of claws back on the profit growth that as you're going through an investment phase, and you have a fairly flattish outcome there overall with benefits to come later?
Yeah, look, it's fair to say we won't see the kind of growth we saw from FY20 to FY21, but yeah, we should still see growth, however, and also obviously growth from the consumer lending as well, assuming that volumes volumes come in around that guidance level, the top end of the net lending. So yeah, we'll see growth from both, but you're right, we won't see that that sort of very significant, more than doubling of profit that we saw in FY21.
Yeah, if I can just get one more question, just to colour around the profit lift. You're forecasting at the top end 8% or $7 million profit growth after tax. So would that kind of reflect, as you say, a better outcome in America and consumer lending, partly offset by weakness on Australian and New Zealand ledgers?
Yeah, look, I think not so much, not necessarily weakness, but yeah, more likely a flattish result in Australia and New Zealand. And you're right, the growth having to come from both the US and lending, correct?
Yeah. Okay, thanks very much for all the updates and the colouring. Thanks very much.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. There are no further questions at this time. I'll now hand back to Mr. Baraghi for closing remarks.
Oh, well, look, great. Thank you very much for everyone who participated on the call. I hope those who didn't ask questions found it useful also. Thanks for your interest in the company, and I'll hand back to the operator to close the call. Thank you.
That does conclude our conference for today. Thank you for participating. You may now disconnect.